Reduce trading costs when managing your FX exposure, and do it in a smart way. Welcome to CurrencyCast. My name is Agustin Mackinlay. I'm the financial writer at Cantox and your host. In this week's episode, we're going to discuss the trade phase of the FX workflow, where risk managers actually execute the derivative transactions to hedge against currency risk. A recent survey by HSBC shows that over the last 3 years, multilateral trading platforms such as 360T and others have been the venue of choice for companies as they execute their FX trading. As much as 69% of traders in medium to large size companies say they execute their transactional FX hedges through such venues. Now, the range of functionalities they offer is quite impressive. Trading in spot, forwards, non-deliverable forwards, swaps and options with hundreds of liquidity providers. The ability to select your own liquidity provider. The conditional order setup that includes stop loss and profit-taking orders. And best price execution that puts liquidity providers in competition with one another. This last feature, best price execution, is surely the most well-known and the most influential of these properties of multilateral trading platforms, because it creates real-time price comparison between a host of liquidity providers that are put in fierce competition with one another. It has led to what Philippe Gélis, CEO at Cantox, calls a spectacular compression in FX. Make no mistake, the reduction in corporate FX trading costs is unambiguously good news for corporations as they seek to manage their currency risk. There remain, however, at least two important hurdles to tackle. Number one, while the trade execution itself might be completely automated, there remain at many companies some tasks that are manually carried out. So, for example, inputting the trades on the platform, selecting the liquidity providers, and even confirming the trades. Number two, and even more important, more attention needs to be placed in terms of integrating the trade and the pre-trade phase. So, for example, our treasury team has decided to trade only once a fortnight. The real question from a risk management point of view is that the right moment to trade if you're looking, say, to smooth out the FX rate over time? The fixation with lowering trading costs, while understandable, is unwarranted. Going forward, treasurers are going to care less about whether they think 9 or 10 basis points if they are secure in the knowledge that they have the right automated hedging program in place that would allow them to protect the company against, say, a 2% move in currency markets. The real value proposition of multilateral trading platforms lies elsewhere. They are fast becoming an integral part in the process of seamlessly integrating the pre-trade, the trade, and the post-trade phase of the FX workflow, thanks to currency management automation solutions. This process of automation comes with an added bonus. Application programming interfaces allow your data to seamlessly flow between different company systems, especially ERP and TMS, reducing operational risks and freeing up valuable treasury resources. Thanks for tuning in today. If you enjoyed this video, make sure to like, share, or subscribe to our channel in order to keep up to date with upcoming episodes.